Good day, I'm Marcel Ruiz, a fund analyst for PSG Multi-Management. Today we are going to have a quick review of fund performance for our local PSG Wealth funds, followed by a closer look at how the PSG Wealth Creator Fund of Fund manages concentration risk. We will then discuss the funds on the radar screen and changes that we've made in our local funds in 2017. Starting with a snapshot of the performance over various periods up to the end of 2017. With our best of breed strategy, we aim to either perform in the top or second quartile. Green indicates top quartile, while blue indicates second quartile. The gold bubbles illustrate the minimum investment horizons for the funds. All the funds delivered top quartile returns over their respective minimum investment horizons and since inception. This table illustrates just how robust our investment philosophy is and has been over time. The PSG Wealth Enhanced Interest was ranked first over its 1-year minimum investment horizon, the Income Fund of Fund 16th, the Preserver 14th, the Moderate Fund of Fund 12th, and the Creator Fund of Fund 23rd. This slide illustrates the asset class returns in South African Rand over the past 5 calendar years. 2017 was quite an interesting year in that local political events dominated the news. There was a strong recovery of the Rand on the back of much needed positive sentiment after Cyril Ramaphosa's election as the new ANC president. Investors in domestic equities reaped the rewards in 2017 with a return of 20.95% after muted returns in 2015 and 2016. There was a very positive global backdrop for global equities. This asset class returned close to 24%, but only 10.8% in Rand due to the Rand strength in 2017. Perhaps the most important point of this slide is how the top performing asset classes vary significantly from year to year. This highlights the benefits of a well-informed and diversified portfolio across equities, bonds and cash, and domestic and offshore exposure. I'll now quickly run through the performance of the local funds, starting with the Enhanced Interest Fund. This is our domestic-only cash and cash equivalent fund. The fund delivered a decent return of 8.1% in 2017, outperforming cash and inflation quite comfortably. We prefer to look at rolling returns rather than growth charts, as growth charts are highly influenced by the specific start and end dates, whereas rolling returns places an emphasis on return consistency. The enhanced interest has outperformed the CSA South African money market average over all rolling 1-year periods since inception of this fund. Moving on to the PSG Wealth Income Fund of Funds, our South African Multi-Asset Income Fund. This fund has delivered solid results in 2017. It outperformed the STEFI 12-month by 0.63% over the last year and by 0.94% annualized over the last 2 years, the fund's minimum recommended investment horizon. The rolling returns illustrate that the fund has outperformed the STEFI 12-month over all rolling 2-year periods since inception. The fund has also outperformed South African CPI comfortably over all rolling 2-year periods since inception, so it has provided clients with an excellent vehicle to preserve the real value of their capital while providing a high degree of capital stability. Next is the PSG Wealth Preserver Fund of Funds. This portfolio is our stable or cautious fund solution that may have up to 40% in equities and 25% offshore. The fund outperformed and delivered excellent returns in 2017, outperforming CPI plus 3 by 1.27% and the peer group average by 0.73% over the last year. Over the fund's minimum investment horizon of 3 years, the fund has outperformed the peer group average by 1.33%. As with the other funds, the Preserver has also consistently outperformed its peer group average over 100% of all rolling 3-year periods since inception. This is testament to the quality of our underlying managers and how we combine them using our split fund approach to deliver consistent peer group beating returns over the mandated investment horizons. Next is the PSG Wealth Moderate Fund of Fund, our most aggressive Regulation 28 compliant fund of funds. This fund may invest up to 75% in equities and 25% offshore. In 2017, the fund returned 11.41%, outperforming the average balance fund by 1.44%. Over the fund's minimum investment horizon of 5 years, the fund has outperformed the peer group average by 2.05%, translating into a very attractive cumulative outperformance of 15.1% over this period. We believe in consistency and that slow and steady wins the race. The translation of small consistent outperformance annually to a large cumulative outperformance over 5 years is an excellent example of this. The moderate fund of funds has comfortably outperformed the average balance fund over all rolling 5-year periods since inception, as the graph illustrates. It has outperformed by 1.83% or more annualized over all 5-year rolling periods. In fact, the moderate fund of funds has done this over all rolling 1-year rolling periods as well. This shows how split funding, in other words, blending fund managers with different but complementary investment styles together, contribute to consistent peer group beating performance over the short term, while not compromising on long-term performance. Lastly, we look at our South African equity general solution, the PSG Wealth Creative Fund of Funds. This fund has delivered 13.6% in 2017, outperforming the average South African equity general fund by 0.8% for the year. Over the last 5 years, the fund has outperformed the peer group average by 2.37% annualized, once again translating into an excellent cumulative outperformance of 17.5% over this period. With the PSG Wealth Creative Fund of Funds outperforming the peer group average over all 5-year rolling returns, all of our 5 domestic fund solutions have outperformed the peer group averages over 100% of the minimum investment horizon rolling periods for those funds. So in today's presentation, I'm focusing on how the PSG Wealth Creative Fund of Funds, and by extension active managers, manage concentration risk. Concentration risk is the opposite of diversification, where your investments are concentrated in relatively few assets. This table shows the top 10 of the Creator and 2 of the commonly used FTSE JSE broad market indices, the top 40 and the SWIX. The indices are heavily weighted in the top 10s, 66 and 50% respectively, and more than 23% in just one stock, Naspers. Active managers are tasked with not only providing benchmark beating returns, but to also manage risk in their funds in a prudent manner. The Creator's 33% allocation to its top 10 is evident that the underlying active managers take concentration risk into account when determining their overall portfolio construction, by ensuring true diversification. Over the last few years, assuming excessive concentration risk has favored investors, especially with Naspers' great performance. But as we have all seen too often, greed causes people to ignore these risks, even if they are blatantly obvious, until it is too late and the risks materialize. This graph shows the performance contributors of the FTSE JSE All-Share Index in 2017. As you can see, a very large chunk of the performance has come from just 5 stocks. Naspers alone contributed almost 10% to the index's returns. Steinhoff detracted significantly from the index's returns. This illustrated how much a single stock can detract from overall performance, especially if it has a large weighting in a portfolio. If this had to happen to a stock that constitutes 23% of a portfolio, the effects would be way worse. This graph illustrates just how concentrated our broad market index is versus its global developed peers. It shows the cumulative weight in the index of the largest 100 shares in the FTSE JSE All-Share Index and the USA's S&P 500. The top 100 shares of the All-Share constitutes almost 100% of the index, while the S&P 500's top 100 shares is just over 60% of the index. Further to this, the S&P 500's top 100 shares have about the same weight in its index as the top 17 shares in the All-Share Index. The All-Share Index largest counter, Naspers, is almost 20% of the All-Share Index, while S&P 500's largest counter is just 3.8% of the index. So Naspers has continued delivering good results, and many fund managers have favorable outlooks for the company. So is it worth taking concentration risk seriously? The answer is yes, and this chart shows just why. The charcoal shaded area using the left-hand axis shows the percentage of active managers outperforming the All-Share Index net of a 50 basis points fee. The gold line shows the performance of the All-Share Index net of a 50 basis points fee using the right-hand axis. During the advent of the global financial crisis in 2008, the All-Share Index fell 23.23% according to Morningstar Direct. After costs, a passive fund tracking the broad index would have fallen about 23.73%. The CISA South African Equity General Sector results for 2008 show that 43 out of the 62 funds, or about 70%, suffered a smaller loss than a passive fund tracking the index net of fees. So when the index performs poorly, active managers tend to outperform. This provides evidence of how active managers can effectively manage downside risk and the value that they can add doing just that. So PSG Multi-Management believes that active managers play an integral part in a portfolio, not just for adding alpha, but also to manage risks, such as concentration risk. For more information on concentration risk and how active managers manage this risk, please read the Domestic Solutions article in the latest Research and Strategy Summer 2018 report. We'll now briefly look at the funds on the radar screen. Just to recap quickly, funds appear on the quantitative radar screen when they underperform their benchmarks over 1 month, 3 months, 6 months, and 12 months, all inclusively. While funds appear on the qualitative radar screen when there is a change to their people, process, or philosophy, or ad hoc reasons that require further due diligence and investigation to ensure that the fund will continue to deliver on its mandate and its role within the fund of funds. When funds appear on the radar screen, we do not give them any new inflows until they are removed from the radar screen. This is an additional way in which we manage risk for our investors. There are no funds on the radar screen for the PSG Wealth Enhanced Interest Fund or PSG Wealth Income Fund, also not for the PSG Wealth Moderate Fund of Funds. The PSG Wealth Preserver Fund of Funds, there are 3 funds on the quantitative radar screen: the Coronation Balanced Defensive, Investex Cautious Managed Fund, and Sim Inflation Plus Fund. We also have Investec Cautious Managed on the qualitative radar screen for this fund. For the PSG Wealth Creator Fund of Funds, the Investec Equity and Alt Mutuals Investors Fund is on the quantitative radar screen. So major changes on the local side over the last year happened exclusively within the PSG Wealth Enhanced Interest Fund. In April last year, we switched out of our investment in Stanlib Segregated Mandate in favor of the Stanlib Enhanced Yield Fund, a unit trust. We prefer unit trusts as it provides additional liquidity where you do not own the underlying securities directly, but rather units in the collective investment scheme. In November 2017, we invested in the Coronation Jawbal Plus Fund by rebalancing the portfolio to ensure equal allocation between the unit trusts in the portfolio. We believe that these changes will contribute meaningfully towards the fund's performance going forward. So that is all for this month. All the best for 2018. And should you have any further questions, please feel free to contact your dedicated investment specialist. Thank you for your time.